2025 has been a defining year for precious metals. Both gold and silver have broken through long-standing resistance levels with impressive rallies that have surprised analysts and investors alike. Silver, long considered the undervalued sibling of gold, has been a standout performer, outpacing gold's gains and grabbing headlines across financial markets. Gold itself has not lagged. It continues to validate its reputation as a primary safe haven asset when global uncertainty rises. Understanding where we stand now and how many ounces of these metals to accumulate before 2026 requires walking through current trends, influencing factors, and realistic expectations supported by market data and expert price forecasts. Let's start with gold. For the first time in history, in late 2025, gold traded above $4,400 per ounce, a milestone that reflects the rapid appreciation in the price of this traditional store of value. Analysts reported annual price moves exceeding 60% year-to-date, with gold pushing into previously unthinkable trading zones. The surge to these levels has been driven by a combination of macroeconomic factors: prolonged inflationary pressure, expectations of Federal Reserve interest rate cuts, and continued geopolitical tensions. These dynamics have increased demand for gold as a hedge against currency weakness and financial market unpredictability. Institutional forecasts now frame gold's outlook for 2026 in terms never before seen outside of the most bullish market cycles. Major financial institutions and macro strategists, including Wall Street banks, have published projections that point toward continued gains for gold throughout 2026. Many analysts believe prices could average near or above $5,000 per ounce by the end of the next year, and some even point toward targets beyond that if current structural trends in demand persist. This kind of forecast signals not only momentum but structural shifts in how global investors and central banks view gold. Central bank purchases have been strong drivers in this rally. Countries from Asia to Europe have increased allocations to gold within their sovereign reserves, diversifying away from traditional fixed income instruments. This structural demand reinforces upward price pressure because it represents buyers who are not trading around the edges but holding for long-term balance sheet stability. From an investment strategy standpoint, that implies purchasing physical gold, whether bars, coins, or certified bullion, can be more than just seeking capital gains. It positions an investor to protect purchasing power and diversify risk across financial cycles. But how many ounces should one consider before 2026? There's no universal answer, because allocation should always reflect personal financial situations and goals. However, seasoned analysts typically encourage a tiered accumulation strategy rather than attempting to time the absolute bottom or top of a price move. A tiered approach means buying modest amounts at regular intervals as prices advance, rather than trying to buy a single large block at once. This method reduces the impact of price volatility and allows investors to average their cost basis over time. Given the current price zone of over $4,400 per ounce as of late 2025, and considering forecasts that see prices approaching $5,000 or higher in 2026. A tiered plan could involve dividing your total budget into monthly or quarterly purchases between now and mid-2026. This spreads risk and avoids leaning too heavily on short-term price fluctuations. Experienced allocation models often suggest physical gold holdings of 5% to 12% of an overall diversified portfolio for risk-conscious investors. More aggressive investors looking for growth and store of value exposure sometimes push this allocation higher. Now let's pivot to silver, which has captured significant market attention in 2025. Throughout the year, silver prices surged dramatically, breaking long-standing ceilings that had held since the early 2010s. In late 2025, silver prices climbed above $65 per ounce, a historic high driven by robust investment demand, production constraints, and growing industrial utility. This performance outpaced gold's gains in percentage terms, as silver's year-to-date return exceeded 120%. Silver's unique role in the market gives it dual characteristics. Like gold, it is sought after as a store of value. Unlike gold, it is also a critical industrial metal with demand tied to green technologies, solar energy, electric vehicles, electronics, and other high-growth sectors. Industrial demand alone has created supply tightness, because primary mine production has struggled to keep pace with global needs. When an asset is both a store of value and an industrial commodity, its price dynamics can amplify compared to a metal with a purely monetary role. Forecasts for silver's price into 2026 show a variety of scenarios, from conservative to strongly bullish. A broad range of analysts sees silver trading comfortably above $65 per ounce for most of 2026, with technical models extending targets to the $70.88 range based on continued structural deficits and price discovery patterns. A handful of the most bullish forecasts, often cited by market commentators and high-profile analysts, even suggest the possibility of silver reaching 100 or more per ounce by late 2026, though these scenarios remain more speculative. That divergence in price outlooks highlights one of the most important truths about silver investing. Volatility is greater here than in gold. Silver's market liquidity is smaller, and its prices can swing more widely on sentiment and macroeconomic surprises. This means that while silver offers higher potential upside than gold, it also carries greater short-term price risk. How many ounces of silver should an investor consider accumulating before 2026? Many strategic approaches again point to regular, systematic accumulation rather than timing market peaks. Because silver is substantially cheaper per ounce than gold, investors can often buy more ounces for a given capital outlay. A balanced portfolio might allocate slightly less overall weight to silver than to gold, for example 3% to 8% of a diversified investment portfolio. But within that allocation, silver's growth potential can make it a compelling addition. Silver accumulation can be particularly attractive when prices dip into support zones established by technical analysis. When silver holds above breakout levels, such as above $60 or $65, it confirms market confidence and a transition from resistance to support. Buying at or near confirmed support levels, even in modest amounts, can position investors well for future rally waves. Another tool investors often use when buying precious metals is watching the gold-silver ratio, the number of ounces of silver needed to buy 1 ounce of gold. Historically, this ratio has fluctuated widely, but when it reaches elevated levels, it can suggest that silver is cheap relative to gold. A declining ratio often signals silver beginning to outperform gold. Tracking this ratio alongside price trends can help refine entry points for silver accumulation. It's also important to mention the means of ownership. Physical silver and gold, whether coins, rounds, or bars, provide direct ownership with no counterparty risk. For investors who prefer liquidity or ease of trade, precious metal ETFs and trusts also offer exposure, though they introduce different risks compared with physical holdings. Choosing between physical and ETF exposure depends on your personal strategy, storage preferences, and liquidity needs. As 2026 draws closer, the market narrative for both metals remains bullish but nuanced. Gold is widely expected by many analysts to continue its upward trajectory, serving as a hedge against currency risks and economic uncertainty. Silver's dual role as both a safe haven asset and essential industrial material adds a layer of growth potential and volatility. Accumulating both metals in a structured, disciplined way, rather than betting on perfect price timing, can help align investment outcomes with market realities. As we move into the heart of 2026 planning, one truth is clear. Gold and silver remain central to many investors' minimum portfolios, not because they offer guaranteed returns, but because they play specific strategic roles in balancing risk-preserving capital and providing diversification when traditional financial assets face uncertainty. First, understand that precious metals investing is not just about chasing price moves. It's about structure, timing, and proportion. This means defining a clear accumulation strategy, setting realistic targets, and having rules for reducing exposure or trimming holdings during market extremes. One widely respected method among experienced precious metal investors is the systematic accumulation approach. Instead of trying to buy a large allocation all at once, which risks poor timing and emotional decision-making, investors make regular, smaller purchases over time. Analysts and fund managers often recommend this approach because it helps average your cost basis and reduces the risk of buying at short-term highs. For gold, even in a strong rally, using monthly or quarterly purchases through physical metal or bullion funds creates a smoother entry path. This strategy is especially relevant right now because expert forecasts show both potential continued gains and periods of price consolidation in 2026. In fact, major institutions like the World Bank and Metals Focus project that gold will stay elevated into 2026, but may grow at a slower pace compared with 2025. Gold's average price across 2026 is expected to stay well above historical norms, supported by ongoing central bank demand and geopolitical drivers. Even with this backdrop, several forecasting models call for gold to consolidate or trade in a range before any strong new rally resumes. suggesting that patience and a systematic accumulation plan could serve investors best. So how many ounces should you aim to accumulate before 2026? There's no precise universal number, but there are practical guidelines. Many advisors would consider allocating between 5% and 12% of your total diversified investment portfolio to gold. Within that range, if you're closer to retirement or more conservative, leaning toward the lower end may make sense. If you're younger or seeking broader diversification and protection against inflation and currency volatility, the higher end could be appropriate. The key is that this allocation should represent a part of a wider diversified strategy, not the entirety of your investment plan. Silver requires a slightly different lens because its price behavior and market structure differ from gold. Silver tends to be more volatile, partly because its market is smaller, and partly because it combines both monetary hedge characteristics and industrial demand influences, especially in technologies such as solar panels, electronics, and electric vehicles. This dual demand profile means silver can move more sharply, both up and down. Experts generally view silver as offering higher potential upside, but with greater short-term swings. This makes it a good tactical addition for investors who can tolerate volatility. A common allocation guideline for silver is 3% to 8% of a diversified portfolio, although more aggressive investors might go higher based on their risk comfort. Remember, because silver prices are an order of magnitude lower per ounce than gold, you can often accumulate more physical ounces with a similar budget. But that doesn't automatically mean it as a better investment. You must balance the potential for higher returns with the reality of bigger price movements and demand fluctuations. When setting targets for how many ounces to buy, consider creating tiered price bands for buying. For example, you might decide to buy a baseline amount of metal regardless of price each month, say 0.1025 Oz of gold and 1 to 5 Oz of silver, scaled to your budget. Increase purchases if prices dip toward defined support zones, e.g., hypothetical pullbacks to price levels that historical data or technical analysis identifies. Reduce size or pause buying if metals move sharply above trend lines, or hit levels driven by extreme speculative sentiment. This structured approach avoids emotion-driven decisions like buying heavily after a big price spike or selling prematurely during normal volatility. Risk management is just as crucial. Precious metals do not yield interest or dividends, which means your investment returns come solely from price appreciation. As a result, you must manage your expectations and be ready for periods of price stagnation or consolidation. Analysts have noted that gold's recent price run might invite temporary pullbacks or sideways movements before potential further gains. A disciplined investor shouldn't panic during these phases. Rather, use them as opportunities to add to positions at better average prices. Diversification is another risk management cornerstone. While gold and silver are excellent portfolio stabilizers, they shouldn't displace other asset classes entirely. Treasuries, equities, real estate, and other commodities each have unique roles. Precious metals should balance and hedge rather than dominate a diversified strategy. Macro factors also play a substantial role in shaping the metals market as we approach 2026. Federal Reserve monetary policy continues to be one of the most influential drivers. Easing bias, that is, expectations of lower interest rates, tends to support higher metal prices because it reduces the opportunity cost of holding non-yielding assets, like gold and silver. A weaker US dollar also increases demand for dollar-priced commodities from holders of other currencies. Both conditions have contributed to the strong rally seen through 2025. Geopolitical tensions and global uncertainties, whether trade policies, currency pressures, or conflict risks, remain another consistent support factor for precious metals. These kinds of conditions tend to strengthen gold's role as a safe haven asset and can also pull silver along because of correlated investor flows. If these tensions persist into 2026, they could keep upward pressure on prices, particularly during episodic stress periods. Industrial demand, particularly for silver, may also grow as technologies that rely on this metal expand. Solar energy installations, electric vehicles, and electronics contribute to a structural demand increase that many analysts cite as a leg of silver's long-term story. However, because industrial demand can ebb and flow with economic cycles, silver's price might sometimes diverge from gold's pattern, making vigorous ongoing assessment important. Finally, one of the most overlooked aspects of precious metals investing is liquidity planning. Decide in advance how and where your metal will be held, whether in institutional vaults, allocated storage, home safes, or metal-backed funds. Each choice has implications for liquidity, cost, and ease of future sale. In summary, accumulating gold and silver before 2026 isn't about hitting a single magic number of ounces. It's about structuring your plan, using systematic and disciplined buying, observing macroeconomic and price signals, and aligning your accumulation with your risk tolerance and financial goals. Gold serves as a defensive anchor in uncertain times, while silver offers growth potential linked to industrial trends and investment demand. By balancing these roles thoughtfully and consistently, you position yourself to benefit from precious metal strengths while managing risks across investment cycles.